All right, everyone. I hope that you've had a wonderful week. So I wanted to quickly give an introduction as to what it is that we were going to talk about during this meeting. So this is Unit 2 is where we get into the meat of a lot of things, but at the same time, we don't dive too deep into it. So for example, we're going to talk a lot about initial public offerings today, which AKA is when a private company transitions to a public company. The reason why you can buy shares of stock on the New York Stock Exchange, as an example. We're gonna talk a lot about that today, but it's in chapter 3 that we're really going to isolate it and dive deep into, well, what a prospectus may look like whenever a company does an initial public offering, and what respective research reports after an initial public offering would look like, aka those buy, sell, hold recommendations that you might read as an individual investor to gain insight onto a stock. So let's begin. If everyone can, just scan this really quick. Then, perfect. And again, this is just our website, right? After the meeting today, in the case that we do finish, this meeting might be a bit long and some of the content might leak into next week's, because next week is Thanksgiving break, 2.3. So I'll show you guys what 2.3 will look like later. It might not be today. And then, of course, this is our link tree. In the case that you want to look at the YouTube, Google Classroom, etc., you might want to scan that, but I'll come back to that at the end. All right, so let's just get started, right? What I want you guys to understand is that there are two different types of companies. There are private companies and there are public companies. And like I did mention, when a company is public, right, they can list shares of their stock on the stock exchange, so the general public, like me, you, David, Cullen, all of us, can buy stock easily. However, when we get to private companies, that's where things become a bit more gray, a bit more difficult, right? So let's talk a bit about public companies. Investment banks oftentimes deal with public companies. These are companies that, like I did say, have stock listed on a stock exchange. So there are multiple stock exchanges, right? The New York Stock Exchange, NASDAQ, important to keep note of that. Or have publicly traded securities. Does anyone remember what a synonym for the term securities is? What's up, Crawford? Yeah, investments, basically. Securities and investments go hand in hand. Make sure you remember that and replace securities with that term as I do talk about it. That people like you and me can buy. So when you have publicly traded securities / investments, that just means that general people can buy them. What is it that general people can't buy? We're going to get to in a second. But whatever happens with public companies is always available to the general public. So recall 1.3, when we looked at different financial statements and financial reports, right? We dove really deep into that. And we talked about how for public companies, you can access these literal financial reports and statements via EDGAR, via the SEC's filing database. And I showed you guys how to access that too. So in the case that you want to see that, make sure to head to the 1.3 video on the Google Classroom or YouTube. But just to clarify, when a company like Microsoft will buy LinkedIn, as an example, Microsoft is public, every detail about the transaction is shared with the public. So, that's one thing that public companies face, possibly a lot of scrutiny, right? Every detail of that transaction is given to people like me and you. Searching for public companies on the database, I talked about that. Now we're going to get into private companies. So at times, investment banks will also deal with the sale of, private companies. These are companies for which there are no publicly traded securities / investments. So big difference here, big thing for you to note. Public company is defined by, hey, do I have publicly traded investments? Private companies defined by, hey, do I have, investments that aren't available to the public? Are the majority of my investments privately held? And we're going to talk about what exactly that means in a second. Who it is that holds these investments privately, right? Stock, bonds, etc. mean you that the average investor can buy. So, what I want to talk to you about now is market value. Does anyone know what market value or market capitalization is and how it's calculated? Kind of. So market value, which is also, I believe, known as market cap, is calculated by the price per share of a stock multiplied by the number of shares it does have outstanding. So I believe Apple has the highest market cap of all companies right now. It's around like 2 trillion something, but someone can fact check me on that. So the beauty of public companies is that you can calculate a defined market value because, two things that make up the market value equation are there readily available for you. That being the price per share of that company, right? The shares are available to you on the New York Stock Exchange, etc. And the number of shares outstanding. Does anyone know what shares outstanding really means? Like, it may be implied, but what exactly does it mean? Exactly, right? So it could be shares held by the employees of that company themselves, shares held by you, shares held by institutional investors. Just know that it's the amount of shares that do exist for that company. Of these companies, private with no publicly traded securities is a bit more difficult to determine. So what that means is when we're talking about market value, easy to determine for public companies, right? They have both of those things. Private companies, not so easy. It gets a bit hazy over there. And because all information about stock pricing for public companies is available, again, it's easy to determine their market value. The private company's market value is indeterminable, essentially, and you have to figure out other ways to value this private company. Really, the sentence I want you to remember here is what potential buyers are willing to pay and what the seller is ready to accept. Essentially, when a private company is sold, or when you're trying to attach a value to a private company, it really just is a meeting of the minds. And you're going to get to some examples in a second that'll really show you, hey, some minds did not work over here. But some general valuation methods we may have for a private company, considering that market value is out of the question somewhat, are discounted cash flow analysis. Is a discounted cash flow analysis. You can look back at 1.3 if you don't remember what that is. Asset valuation. So looking at the specific assets of a company, valuing those, and then maybe combining them together and putting some number on the company. So like a specific asset could be, who knows, a manufacturing facility of a specific company. It really just goes on from there. And then comparable analysis. So note that in finance, we really like those apples to apples comparisons. That's why we have those generally accepted accounting principles, aka GAAP. Accounting is a part of finance, by the way. So when we talk about comparable analysis, that's comparing two very similar companies, one being private and one being public, to then kind of determine what it is that this private company may be valued at. So maybe comparing Apple and Microsoft, say that Microsoft was private, right? Both of them sell a pretty similar line of products, although not exactly the same, but you might be able to compare the two if one hypothetically was private and attach a value on the other. Or if one hypothetically was public, one being private, look at the public, then attach the value to the private. So why do some entrepreneurs sell their business? So this is kind of separate from over here, but not really. So when you're an entrepreneur and you're starting a business, this already assumes that your business is a private business, right? You haven't contacted an investment bank and said, hey, I want to make my company public. I want to make shares of my company available for the public to buy via stock exchanges. When you start a company, it is private. So why sell those companies? Why do people, instead of scaling it up to a public company, just sell that private company? Well, while some entrepreneurs may have the ability and grit to scale their company to a very large public level, most people who start a company, which again is at first private, know that making a successful public company takes more than just one hit product. There are so many facets of growing a company that requires them to be a successful public company. It's not just one hit product. So you may not have the grit to scale that up. That's okay. Or your company may kind of be running out of ideas, or may just be specialized in one area that's somewhat niche, making it a really good add-on to some already big company that is selling a variety of different products. Right? So in these types of deals, investment banks are often required to put a price on that private company and its technology. Again, this being the sale of that private company to an already existing public company. We're putting a value on that. Crawford, who's next? Here you go.
Because not as many resources are available to determine the value of private companies, many times the valuation of you put on them is a bet. For example, Yahoo's purchase of Tumblr, which is $1 billion, is turned to Verizon's purchase of Yahoo and the sale of Tumblr for $3 million. And the large disparity of the prices show that the value of companies can be extremely subjective.
Exactly, thank you. So like Luna did mention, a $997 million disparity. That's freaking insane. If I lost $997 million on a deal, I would be pretty pissed off, right? And that's where it gets to the gamble. Sometimes it is a gamble with these private companies. And what I really want to hone in on is the fact that market value may be one of the most accurate ways of determining the value of a company. Why? Because you're measuring what it is that the public thinks this company should be valued at. If you've ever looked at a stock graph, or if you search up Apple's stock graph right now, you're going to notice that that value is not the same throughout the day. It fluctuates. Why? Because people fluctuate. The idea that people have of this business does fluctuate. Hence, fluctuations in the stock price. And hence, when you add up that equation, stock price multiplied by shares outstanding, you're going to get different valuations throughout the day and throughout time. But again, because it's the public that's determining this valuation, a lot of the times it can be one of the most accurate looking at it from a really long timeline. So yeah, and that was actually dictated by not me, but Leon Cassidy of Evercore. We interviewed him last year. He's an associate, and I think we interviewed him for Chapter 2. We might interview him again, or a new investment banker. We'll see. Who had going private transactions? All right, I'm going to cover this one. While it is the dream of most companies to go public, there are many pressures associated with going public. One of these being the big things, right? Constantly disclosing your financial information, your 10Qs, your 10Ks. It's like you as individuals, right? Disclosing your report cards to your parents. It kind of puts a lot of pressure on you, always wanting them to see that you have an A. And sometimes you don't have an A, B, C, or D, and you don't want them to see that, or you feel ashamed of yourself. Put your feet in the shoes of a company now, right? It's very similar. And sometimes, because of this pressure, public companies will turn themselves private via going private transactions. Funny story, actually. Michael Dell did that for his company. And again, Michael Dell did go to this school, right? And I can talk a little bit about that, but I want to just make sure to explain going private transactions further. So when an investment bank aids a public company revert back to a private company by allowing private investors to buy back the majority of a company's shares. So some examples of private investors, like we did talk about in 2.1, would be private equity firms or the management of a company in the case that they decide to ensue in a management buyout. And of course, both of the mediums of transaction for these two private investors are that leveraged buyout, right? Does anyone remember what a leveraged buyout is? Well, what does leverage mean? Exactly. So it's buying some company with a large amount of debt and then using the cash flow, the revenue of that company to pay off said debt. Meaning that whatever you buy, whatever company you buy, you want to make sure it's making a lot of money. Otherwise, you're screwed, right? You're going to go bankrupt because you can't pay back that loan with the said revenue of that company. So talking a little bit about Michael Dell right over here, Dell was a public company, and it now is a public company. Between that period, it went private at one point with the management buying shares of it from current investors. Why did they do that? Because they wanted to appease long-term investors. Look, short-term investors, those that invest in the stock of the company for a short period of time, want quick profit so that they can sell and make quick profit. They want the stock price to go up as fast as possible. And that's not always ideal or in line with the company's virtues, with the company's values. And a similar thing was going on with Dell. So he decided, you know what? Right now, what I want to do is appease my long-term investors. I care about the longevity of my company. So I'm going to buy it back from a lot of these investors, especially the ones that are short-term. And then I'm going to remanage and restructure my company. In this period, my company may not appear as profitable as it could be. But look, I care about the long-term. And eventually he came back. Eventually republicked it. And now it's more profitable than ever, right?
Just hold this.
Yeah, or you
Okay.
can attach it.
Okay, I'll hold it. Okay, so to understand private placements, you should understand the converse of it first. So private placements is when a company sells stock directly to investors without an IPO. So to understand how private placements work, you should understand how an IPO works, which I think Ion already explained. So an IPO is where a private company goes public on the public stock market. So for example, the New York Stock Exchange, so like the NYSE, for example, is an example of a stock exchange in which you can go public on. So that's an IPO. However, private placements are the opposite of an IPO. So instead of going public, or rather, instead of trying to gain investors through an IPO, which are from public investors, you get it from private investors. For example, hedge funds, etc. So the question you should ask yourself now is, why do companies do this, right? Instead of getting investors from the public, why do we want to get it from the private? Well, there's three reasons. First is lighter regulations. So when you first go public on the New York Stock Exchange, or you create an IPO, you have to have auditing. A lot of companies audit you. You have to publish financial statements because the SEC has to make sure that your company's legit. They have to have a ton of regulations, etc. However, when you go through a private placement, it's more, as the word suggests, it's more private, right? It's more like closed. It's just you and your private investor. It's you and X hedge fund, you and X, like person. Second, it's lower costs. So when you do go public through something like an IPO, obviously there's a ton of paperwork. There's a ton of like lawyers involved. There's a lot of underwriting to determine the stock price of said IPO. But when you go, when you try to create investors through the private market or through private placements, it's much easier because you no longer have to have all of these miscellaneous like payments. Third, it's limited to sophisticated investors, right? So anyone, or not everyone in this room can go on the stock market, but anyone over like 18 can go on the stock market and buy a stock if a company IPOs. However, not everyone who's over 18 can get into these private placements because private placements are something that are limited to only like private investors, and that's obviously better. So for example, it is going to be given to high net worth individuals, companies, institutional investors, hedge funds, etc.
Perfect. Thank you so much, David.
So yeah, as David was saying, a private placement may seem like an ideal option for a new business, but because like the lack of regulations and stuff, but they do come with some drawbacks. So first thing, supply and demand. As he was talking about accredited investors, that may seem good, but because of that, you can't offer it to the public, which means there may sometimes be more shares available than buyers wanting them. And a fun fact is that studies show that companies that sell via private placement have a 30% lower than private companies. So yeah. Another example, SEC limitations. Basically, a company can only have 500 shareholders before it has to register with the SEC. And basically, that means you can't. Once you get those 500, you basically go less private. So it ruins the whole point of it. And also, a side note, this doesn't mean that a company goes public because they have to do it through an IPO or initial public offering. It's to register with the SEC.
So yeah, like Shannon did mention right over here with that 500 shareholder limit, just put yourself in the shoes of a private company and a public company, right? If they were allowed to cross that threshold and have the same amount of shareholders as a public company did, but at the same time face less scrutiny when it came to their financial reports, it would be really unfair, right? So they obviously have to have one thing that's somewhat handicapping them as a private company who gets to share less of their information to the public. Also, really take note of the supply and demand portion right over here, right? Because you have less investors with the same amount of shares, possibly, meaning that the laws of supply and demand dictate that you're going to have less leverage when it comes to the price of your stock, which kind of leads to the study right over here, which shows that most private placement stocks are valued 30% lower than their public counterparts, or if they did go public. Okay.
Okay. So an IPO is when a company sells a stock to the general public. So anyone who's over 18 can buy equity in this. So this is a extremely big deal for a lot of companies. But if this is like too big of a deal for you and you want to do something like a step below, you can do a pre-IPO capital raising. So this is if you want funding for your company, but you also don't want to have to go up to an IPO. So there's three types. There's bank loans, venture capitalists, and crowdfunding. So bank loans, there's two types of banks. There's a traditional bank and an investment bank. And inside the two sectors of a traditional bank would be a commercial bank and a retail bank. So the retail bank is like a bank we would interact with every day, like Wells Fargo, for example, where you can just deposit checks and stuff like that. A commercial bank specifically interacts with companies and things like that. So these commercial banks will offer a line of credit, which is different than just a regular loan. So a regular loan, let's say you're loaning someone $10,000, you'll just loan them the $10,000 straight up. But a line of credit, you'd say, I'll give you 500 of this $10,000 just like for the moment. So these commercial banks obviously don't want to take very much risk whenever they're giving out loans and things like that. So they only They-
Don't worry, don't worry
This
too
is a
much
big
about
side.
the internet companies part. Just make
Yeah.
sure that, whenever a bank issues a loan, they usually want collateral of some sort just so that they can mitigate their amount of risk. But you can head on to
Yeah.
venture capital.
Okay, so the second type of pre-IPO capital raising would be a venture capitalist. So a venture capitalist is an investor that will buy a large stake of a company, but this doesn't have to be by buying shares in a company like in the stock market. This could also just be an agreement. Like, for example, on Shark Tank, whenever a lot of the sharks will make an agreement to buy a large portion of equity of that company. But specifically to a venture capitalist, they have to use other people's money compared to a shark will just use their own money. So the last type is crowdfunding. So this is just like donations that people will make to help finance a company.
Okay. Thank you so much, Reed. Okay. So, we can normalize clapping, but again, you guys are officers now, so that is your job. But just a few things, right? So collateral, like Reed did mention, is kind of that thing that you put in the middle of when you take a loan out from the bank, just so that the bank is safeguarded from you not paying back that loan. So let's say company A goes to the bank and it's like, hey, I need $1 million. What company A is going to do is maybe pledge one of their physical assets, like a manufacturing facility, and say, hey, look, if I can't pay back this loan, you get this facility. That's all it is. And venture capital, Reed, I really like how he mentioned that, well, when it comes to Shark Tank, it's those sharks that have their own money that are investing within the companies. Whereas with most venture capital firms, it's kind of like private equity, where they themselves are financial sponsors, but have limited partners that supply them with money in order to invest in XYZ product. Note that with venture capital, it's always large equity stakes. So those venture capitalists are trying to take a big portion of your company in return for some cash. And I love crowdfunding. I'm sure many of you guys have heard of Kickstarter, right? It's kind of where like ideas and projects come to life, and we're probably going to do some kind of Kickstarter activity during IBC Social 2. We're still working that out, but crowdfunding doesn't really have anything to do with equity, but like Reed did mention, it's all about donation. So if you donate or pledge some XYZ amount of money, you can get early dibs to that product or something else. So in the case that any of you guys want to start your own business, or you have a really good idea like a board game or a video game, Kickstarter and crowdfunding would be a really, really great place to start.
All right, so the investment banker, their role in the IPO process, of course, they're the middleman, right? Their role is to sell the securities, which again is just, assets, investments, bonds. And the people they sell them to are generally called underwriters. So that's like the name of the person buying it from the investment banker.
And then we have a small video here. I can explain the video if you want. But just one thing I wanted to clarify when we get to the underwriting process, and it will kind of be detailed in the video. So investment banks are generally considered the underwriter, right? So let's kind of explain this underwriting process. Does anyone know what the word underwriting quite literally means? What it means to underwrite? It means to take on a financial risk for a fee. And we're going to get to that risk portion in a second. But it all starts in an IPO. It all starts with a company, right? And this company says, hey, look, I'm ready to go public. I want to ensue in this initial public offering process, and underwriting is coming very soon. So I'm going to label it A, and it's going to say, hey, look, now it's time for me to make my shares available to the public. So I'm going to sell shares to an investment bank. And this is kind of the process of underwriting. Right now, investment bankers are in the middle. What they're going to do with those shares is buy them for a lower price and then sell them to a higher price to some institutional investors, maybe accredited investors, but for the most part, big institutions on the buy side that start off with these shares. So I'm just going to draw this, pretend that's a hedge fund, or I'm just going to put institution. And then it sells those shares. So notice that what it's doing right now is it's buying the shares for a lower price and is selling it for a higher price. And we call that the underwriting spread, right? Sell low, buy high. So what it's already done for this company A right here is alleviate their financial need. It's why do companies go public? Because they want money from the public, right? They realize they can get more money by selling their equity for, money. So what's happening right here is the investment bank is alleviating that financial need, buying the shares for lower, and then it sells it higher to institutions on what we call the primary market. So think of shares like cookies. Right here, the cookies are freshly baked. And, it's a common misconception, but a lot of the times when you buy shares of a company on the secondary market, that money that you had spent is not going to that company. It's going to some institutional investor that sold it to you, who bought it on what we call the primary market. Then this institutional investor is going to go to something like the New York Stock Exchange. And then you're going to access the New York Stock Exchange via a brokerage. And I'm just going to explain this part. It's kind of self-explanatory. Then you're going to go to the New York Stock Exchange and access them via a brokerage and buy your shares. And that's called the secondary market or aftermarket. And then you can sell shares on there too. And that's called aftermarket trading. But it's kind of a big process. And let me explain it once more time. So underwriting, taking a financial risk for a fee. The investment bank right here is taking a financial risk by buying the majority of company A's shares and then selling it to some kind of institution. Right here, when it buys those shares for lower and sells it for higher, it's called the underwriting spread, that profit they do make. And notice that in this primary portion right over here, not primary, that's going to confuse you, sorry. In this former portion right over here, they're alleviating company A of the financial need that is gained by, opening up your shares to the public, right? The investment bank has given them money for their shares. Sells it to the institution. This is what we call the primary market. The institutions bought these shares on the primary market. And then you guys come into play later because you guys are the ones buying shares on the secondary market. You're buying it from that institution that already got those shares from the investment bank. Again, aftermarket trading. So I have a video to kind of detail that for you as well. Yeah.
So who gets the money whenever we sell a stock?
Not the company. Whoever is selling you that stock. And usually it's not the company on the secondary market or the New York Stock Exchange. So it could be an institution that's selling it to you, a few individuals, so on and so forth. The companies will get their money in that beginning portion when the investment bank buys the shares from the company. And we're going to talk about underwriting. We're going to talk about underwriting a bit more in a second, but does that kind of answer your question?
So where does the New York Stock Exchange make their money at?
I don't know. The New York Stock Exchange does a lot of things, but that's a good question. We could probably research it. That's actually a really good question. I don't know how the New York Stock Exchange makes money. Yeah, it might be the commissions they get from each trade that they do facilitate. I think brokerages get commissions too, though. So I wonder how all of that links up. It's probably kind of complicated, but
In a nutshell,
oh, perfect. You guys can hear it now.
it is a service usually provided by a large financial institution that involves it taking on risk in exchange for profit. The service got its name due to the fact that in the past, bankers would take on risks associated with projects such as sea voyages, with them, writing their names under the risk information section. Nowadays, underwriters are involved in anything from the banking and insurance industries to securities, for example, with initial public offerings. As an overly simplified example, 1. Company A decides to list its shares on the open market through an initial public offering, a concept covered in another video. 2. Underwriter A is a major financial institution that believes Company A is an excellent business. 3. As such, Underwriter A buys securities issued by Company A and later on sells them on the open market at a higher price so that it is rewarded for taking on risk. In the end, 1. The people behind Company A are happy because they received a bunch of money. 2. Underwriter A is happy because it was able to sell Company A shares for more. 3. It remains to be seen, based on how Company A share prices evolve, if the investors who bought from Underwriter A will be pleased or not. However, please note that this is an optimistic example. There is the possibility of the market not being interested in buying from Underwriter A at a satisfactory price. The possibility of Underwriter A, quote unquote, tricking Company A into selling at ridiculously low prices, and so on. Let's just say win-win situations aren't guaranteed. All in all, though, this much is certain. There's a clear role in the financial ecosystem for well-funded underwriters who put their capital on the line if rewarded properly.
That's the risk, right? They're putting their capital on the line. Does anyone remember who had this slide? Oh, Crawford's not here anymore. I'll just cover it. All right. So these are the steps of an initial public offering, aka private company going to a public company. I'm going to say that a lot. And by chapter 3, you guys will have initial public offering memorized like the back of your hand, because that chapter literally is all about the initial public offering. But step 1, companies release information regarding their stock sale. Companies give their investors a detailed list of their risk, opportunities, financials. This is called the prospectus. That's that financial report I talked about in 1.3 that you can access via the SEC's filing database, EDGAR. Investment bankers assist by informing investors of all material information regarding their offering. Number 2, contacting investors. It's imperative that companies successfully convince investors to buy. That's where roadshows come in. So last year we talked with an investment banker. He was a managing director at Stifel, and he talked all about the various roadshows that he's gone on. So it's not some unheard of term. Investment bankers literally are going on roadshows whenever we get to that initial public offering phase. And all a roadshow is a meeting set up by an investment banker between companies and then prospective investors that would buy that company's stock, with the investment banker being in the middle of the two as the underwriter, right? So they're already trying to gain interest from those companies. Then we get to number 3, where investment bankers will round up investors. So at these roadshows, investment bankers are going to try and figure out how much these companies are willing to buy their stock for. Or not that, and well, is this company even going to buy? Is this investor even going to invest in this company's stock in the first place? And this is called indicated interest, that latter part that I mentioned. This also includes the part where bankers tally up how much interest a stock generates, and this is called book building. So those few terms that are bolded here, book building, indicated interest, roadshows, you might hear quite a bit when we talk with our investment bankers regarding a lot of stuff over here. So just make sure you remember that, or just go back to the presentation later on. Now, pricing deals. This is important. Underwriters work late into the night before the stock starts to trade so that they can find the highest possible price that the stock would trade for. Now, this price part is really important because we need to maintain an equilibrium. And we're going to get to that in a second. I don't know if we're going to have enough time to cover that last slide in this meeting, but you don't want to price the stock price too high. Neither do you want to price it way too low, because there's always one person within the party that's going to get cheated. So you need to find that perfect price. And then underwriters will later support the IPOs. Investment bankers set the initial price the night before, and those shares are sold to the initial investors. The initial investors are free to sell on the open market, and this is called aftermarket trading. This is where you come into play. So after those initial investors, those institutional investors invest on the primary market, they then sell on the secondary market, and that's what's called aftermarket trading. That's where you go in with the New York Stock Exchange and, buy it from them, or maybe even sell it to them, who knows. All right, so now we get to the primary and the secondary market. David, you got this? Yeah, sure. Yeah. Yes, that's called a direct listing. We don't really talk about that, but that's a good thing to bring up.
Okay. Yeah, so Ion basically described both of them earlier, but the primary market is how securities are created. So they're created through something like an IPO, right? So securities, as Ion talked about earlier, are just like financial instruments, right? So when you IPO a company, shares are created on the market, and that's a security. The secondary market is where these securities are traded. So after the company IPOs on the NYSE or the NASDAQ, for example, the way that a lot of like investors like us are able to trade these IPOs or trade these stocks is on the secondary market. New issue market just means that it's like for new securities. After issue market is that after the security is issued, then you're able to trade X thing. The marketplace where the company issues security for the first time, i.e. IPOs, versus the marketplace where the investor trades on their second-hand security, so we're able to trade these stocks. Prices in the primary market are fixed, so whenever a company IPOs, as Ion already said earlier, there's a certain price, right? It's not like the IPO price just starts fluctuating when it goes public. Like after it goes public, then it starts fluctuating because it goes on the secondary market. But an IPO price has one stable price, while the secondary market has prices that fluctuate. Like every single stock on the stock market constantly changes.
Exactly. Perfect. And then David, if you want, you can explain the next thing as well after the video to clarify. But just a quick little video to further clarify primary and secondary markets.
Academic game tutorials. In this video, we will look into the differences between primary market and secondary market. Securities market can be defined as a market whereby financial instruments, obligations, and claims are available for sale. It is classified into two interdependent segments, primary market and secondary market. While primary market offers avenues for selling new securities to the investors, the secondary market is the market dealing in securities that are already issued by the company. So, let's look into the basic differences between primary market and secondary market in a tabular form. Difference number one. The marketplace for new shares is called primary market, whereas the place where formally issued securities are traded is known as secondary market. Number two. Primary market is also known as new issue market, whereas secondary market is alternatively known as aftermarket. Number two. Direct purchasing takes place in the primary market, whereas indirect purchasing takes place in the secondary market. Number four. Primary market supplies funds to budding enterprises and also to existing companies for its
Direct financing. That's all you need to know.
Secondary market does not provide funding to companies.
It doesn't provide
Number
funding.
five. In the primary market, security can be sold only once, whereas it can be done an infinite number of times in case of the secondary market. Number six. Buying and selling between company and investors takes place in the primary market, whereas buying and selling between investors takes place in the secondary market. Number seven. The company will gain the amount on the sale of shares in the primary market, whereas company investors will gain the amount on the sale of shares in the secondary market. Number eight. Underwriters work as the intermediary in primary market, whereas brokers work as the intermediary in secondary market. Number nine. Price remains fixed in primary market, whereas in secondary market, price depends on the demand and supply force, so the price fluctuates. And difference number 10. The primary market is rooted in a particular place and has no geographical presence, as it has no organizational setup. Conversely, the secondary market is present physically as stock exchange.
Perfect. So it's exactly what David talked about, right? A lot of what he mentioned. If you want to watch that video again, just to give you a quick summary, it is a great video to watch, very informational. What the heck? But yeah, I just wanted to reinforce that concept to you guys because it's so important and we're going to touch on it a lot. Okay, there we go. All right, and we have one last slide. Perfect, we did get everything done in this meeting. I'm pretty glad. So what matters in an initial public offering? So it's kind of what I harped on previously, how there needs to be that perfect price for a stock. And that's what I'm going to further talk about. So investment bankers and underwriters for IPOs within them make sure that the shares of stock issued by the newly public company do not break. Breaking simply means falling below the price that the underwriters listed them for. So the effects of a broken deal would be, well, it's obviously perceived negative by investors who invest in it, and it makes the investment bank look like, well, they're inadequate in their services. They don't know how to price that stock, and that was their literal job. So yeah, what are you doing, investment bank, right? So what we're talking about now is that equilibrium portion I mentioned, or balance. So investment bankers attempt to balance the needs and wants of both buyers and sellers in terms of pricing the shares. Again, appeasing both parties in the transaction. So buyers, if the price of a stock plummets after it starts trading, buyers are going to feel like they're ripped off, right? Whereas sellers, if the price of the stock shoots upwards, they're going to feel like they were cheated, they were shortchanged. I could have sold it for more money. So there's a lot hinging on an investment bank here. Make sure you price that stock properly. And again, finance. This isn't just about investment banking, but finance is all about maintaining your network. Even when it comes to business, right? When you or someone else is doing business, you might have some kind of repeated customer. And you obviously want to appease that repeated customer so that he buys from you again. So it's similar in finance. In finance, especially investment banking, you may have repeated customers, companies that come to you for services again and again and again. And if you mess up one of those services, obviously they're not going to want to come back to you later on. So when it comes to risk, if an investment banking firm prices the share of a stock too high, there may be a chance that they'll have to step in and buy those shares. So this is important, right? Let's say that the stock does break. Sometimes the investment bank will go back in, buy those shares, and they'll figure out how to reprice it so that it's not perceived negatively on the market. Because what can happen is, let's say that these shares are way too high and they just start plummeting on the secondary market. Well, that's going to be scary because what do most investors do, especially ones that aren't accredited, that aren't as informed and as used to risk? They're going to start selling it really fast and make a loss. And that's going to cause the stock price to plummet even further. And an investment bank obviously wants to safeguard against this. They might buy back those shares and reprice them. An example would be when Facebook began trading in 2012, underwriters had to step in and buy the shares of Facebook to keep it falling from below its $38 price share. So this is important because this is what lays the foundation to chapter 3, research reports, those buy, sell, hold recommendations, all of that. We're going to start looking at research reports and figuring out, should I buy the stock, should I not, so on and so forth. But after a few months of the stock trading after an IPO, an investment bank will initiate coverage on those respective shares. They do this for a few reasons, but just know that initiating coverage is a research analyst at the investment banking firm writing a report on the company and stock, which advises the investment bank's clients on whether or not they should invest in this stock. This also really helps that stock gain popularity amongst investors because they have more information regarding the stock, and then they also have some kind of verified individual institution, so on and so forth, looking at it and giving their rating to it. And we're going to talk all about, the science behind research reports, giving those ratings, etc. So this is the credits. Thank you all for coming today. And what time is it, Reed? Okay, perfect. I can show you what we're going to be learning about in 2.3. Okay, so not chapter 3. Chapter 2. Okay, so that should be 2.3. I'll have to fix that later, my bad. But what we're going to be learning about are sell-side and buy-side analysts. This is important. This kind of ties to your research reports. Recommendations, interactions, again, research reports, money making, the trading desk. So now we're talking about sales and trading. Reminder, investment banks have a myriad of ways that they make money as they want to be profitable institutions. So one really big thing they do is trading. So let's say you apply to an investment bank. Usually they're going to have two things that they'll ask you on what you want to go into. Do you want to go into investment banking? Remember, we talked about how investment banking is a literal service of investment banks. Or do you want to go into sales and trading? And reminder, we talked with that investment banker during IBC Social 1, and he was like, oh, well, if there was anything I could do, I would maybe consider going into sales and trading because I love tracking markets. So yeah, that's one really big thing. We're going to talk about that. And we're going to talk about how investment banks make money on trading and help facilitate the trades of other really big institutions so that markets don't fluctuate too much, right? Because some institutions want to dump a lot of stock, and investment banks will have a specific way to do that so that the stock price doesn't fluctuate terribly. And does anyone know what proprietary trading is? I'm just curious. Exactly. Yeah, prop desk. So like proprietary trading is trading using your institution's money to make money for that institution. That was kind of outlawed by the Volcker rule, but prior to that being outlawed, investment banks and all of these institutions that participated in it had some really interesting ways of trading. It was really cool. You guys should definitely research it in your free time. Unfortunately, I don't know any investment bankers old enough that worked in the sales and trading division back in the day where prop trading was legal, but or at least there wasn't as many stipulations around it. But yeah, that's 2.3, and we'll talk about that when we come back from Thanksgiving break. Thank you all for coming. Does anyone need the link tree pulled back up? Okay, we're good? Awesome.